it has been a super hot topic, especially after DLG. I think digital lending guidelines has enabled a BC and an AD era for lending, where you are actually also able to cut out the wheat from the chaff. So it's actually exciting times for folks who are building for lending in the long term. And we are very excited to hear from you guys. I'll quickly introduce both Niraj and Kunal, and then we'll get started with our questions. I would also request the audience to continue sending us Q&As. We'll try to take the Q&A as we go, because this is a 30-minute session. We won't be able to do a Q&A at the end. So just put in your questions and we'll take the questions as we go. So we have with us Niraj Murarka, who is the founding team member and the Chief Risk Officer for LiquiLoans, one of the pioneering NBFCs that have been working in fueling the digital lending wave in India. So super excited to have you with us today, Niraj. Thanks for joining in.
Thanks.
Great, thank you, Niraj. We also have a very dashing founder from a dashing company called Credflow, which has been taking a lot of mind space in the SME space, really helping SMEs unlock their cash flow. So we have Kunal Aggarwal, the founder of Credflow, and really glad to have you with us today, Kunal, and looking forward to hearing from you on how you are building for the SME segment in India.
Sure. Thank you for inviting me.
Thank you so much, both of you. So we'll get started, and we'll also take questions on the way, as you mentioned. So to begin with, the first and the important, I think, question is about embedded lending, right? So we actually ran a poll before the webinar to understand what are the topics that the audience is interested in, and embedded lending came up as one of the really hot topics, right? So I'll start with Niraj. You guys have been pioneering the embedded lending, from an NBFC standpoint, embedded lending as a topic, as a segment. Right. So what are some of the interesting credit products that you are enabling in partnerships with fintechs, with marketplaces, with B2B and B2C platforms? Would love to hear from you, Niraj.
Sure, Aditi. There has been a significant product evolution in the last 3 or 4 years, right? Or maybe like 5-6 years, but most of the evolution has happened, I would say, in the last 3-4 years. 5 years ago, when someone needed a loan, I would think the most appealing 2 or 3 products would be either take a personal loan from a bank, or Bajaj no-cost EMI has still been prevalent, which is kind of, I would say, one of the pioneer in sort of a embedded lending, where you go to a electronic store or electronic website or any other use case, and you need to buy a product and you were able to get a checkout financing. Our idea, like LiquiLoans, was also born out of a similar idea. We wanted to compete in the similar space like Bajaj, where we wanted to do no-cost EMI lending. But over time, we have evolved also as a back-end partner for a lot of fintech players, where we support all sort of new lending products, right? All the way starting from daily EMI, like daily EMI kind of a product. If you think it has existed in India for years, like Pedi sort of a concept, right? Where either you do a daily investment or a daily EMI. But that was like a manual product, so to say, 10 years, 20 years ago. That has been revolutionized into like a digital lending play. Now, a lot of merchants and even few customers, depending on the use case, can take a product where they are able to pay daily EMIs or weekly EMIs, right? Another product which has become a lot of prevalent is kind of a credit line, which gives you the flexibility to draw whenever you want. Unlike a personal loan where you get approved and then you have to draw within a certain time frame. If you don't draw within 30 days, let's say, the loan expires or you have to reapply for a loan. A credit line gives you the flexibility that you can draw down, repay anytime and every time you need, with flexibility of as short tenor as 15 days, with no pre-closure charges, no penalties. That kind of again has upped the game, where a lot of fintechs are able to pitch this product to borrowers at a slightly higher rate compared to a bank where the customer is still bank worthy, right? That is the innovation which is required to be able to get a customer who is bank worthy to be able to apply with a fintech or an NBFC. Otherwise, no customer will take a costlier product by 4-5% from these entities, right? Revenue-based financing has been another product, which again, I think has been much more prevalent in the US, but in India, it came around 2 years ago, where even if your balance sheet is not very strong, but you have got good visibility into revenue, can a lender tap into your revenue at source itself and give you loans without diluting your equity, right? So that product is also I think today there are like 5 or 6 major players in that, and we power a few of them as well. Even in terms of gold loans, and also life has become very different. Earlier, gold loans were done only by banks or NBFCs at branches, but new players have come in where gold loan can be given at your doorstep, and not just gold loan alone. They're also tying up with some other offerings in terms of like personal loans or credit line over and above the gold loan to make it more lucrative for the borrowers. These are, I would say, and BNPL, of course, Bajaj had been doing no cost MI, that has also evolved into smaller ticket BNPL kind of products as well. That again, a lot of players are doing.
Superb. That's a great overview, Niraj. And talking about BNPL and also credit line. Credit line is again another topic of a great deal of interest, especially from a B2B standpoint, right? B2C credit line has been around for a little bit longer, maybe in various capacities, but B2B credit line seems to be emerging quite a bit, and would love to get Kunal's point of view on this, not just on credit line, but on embedded lending from a fintech standpoint, from the standpoint of a platform that is serving MSMEs, right? So the MSMEs and the SMEs are coming to your platform and day in day out using our platform. How do you plug in credit, right? How are you looking at these partnerships? How are you looking at the customer journey? Would love to get your view on that.
So I'll give a broader view on embedded lending, and then I'll come specific to what we're doing at Credflow, right, and how that is relevant in the larger context. I think, for example, in the recent years, this is a hypothesis that I have, and I think, for example, I was reading an article by A16Z as well, right? Eventually, every company will be a fintech company, right? And what that essentially means is that fintech essentially has three components, right? Payments, managing money, and then lending, right? Managing money is basically treasury and enabling them to invest, etc., right? Now what the world is essentially, and especially the lending world is moving towards, is the fact that more and more lending is going to be more flow based and end usage control based, right? And that essentially means that it has to be embedded at the point of sale, embedded at the point wherein there is a consumer interaction happening, right? Now what that essentially means in a B2B context or in a consumer context is, for example, say an e-commerce platform, right, which is at the point of a customer consumer buying a product. There, if you're embedding credit, right, vis-a-vis, for example, a BNPL or a transaction based sort of a lending model, right, that has a much higher propensity to grow, right, and basically grow the credit demand as well as have end usage fund control, right, where you are specifically giving money for a end usage versus, for example, you're giving a consumer loan or a personal loan wherein there is no control or visibility on where the fund is going, right? Similarly, in a B2B case, for example, say in Credflow's context, we are serving these mid-market SMEs in the revenue range of say 2 crores to 200 crores. Now we're embedding credit specifically on the flow, right, wherein our user is, for example, paying his vendors using our platform or is collecting money from his customers, right? Now we're embedding credit basis their flows, wherein he can get access to, for example, a BNPL sort of a line for paying his vendors, or for example, his customer can get access to invoice financing, right? Getting access to money against the goods he sold upfront, right? My hypothesis is that eventually, and there are three players in a embedded lending context, right? One is the provider of capital, which is a FI, right? The bank and the NBFC. The other component is the infra player like a Cashfree, and the third is one which is interfacing with the consumer like a Credflow and, for example, say some of the other platforms, right? Now, and all of these three have a very, very critical piece, right? You need the right amount of capital, the right partners who can be very flexible in terms of building those products. You need that fintech, the interface with the customer. Then you need that entire infra to power all of this in a seamless fashion, right? For example, at Credflow, how we are doing, for example, say BNPL, right? We are partnered with Hyperface for our infra in terms of using their infra for our loan management. We're using Cashfree for disbursements and collections. We're partnered with 3 NBFCs at the backend which are powering us. And we're partnered with a lot of these players like Karza and Perfuse, etc., to power and figure out what the credibility of the customers, and then our own data to basically power whether the customer is even eligible or not for those for that financing, right? So I think eventually the entire ecosystem is moving towards in a direction where all the players will come together to enable lending to both businesses as well as to individuals.
Great. No, that's absolutely true, Kunal. In fact, for us as a payment and API banking company, while of course we start with the payment leg of the journey, but now where we are moving towards is being the API infrastructure, right? The lending infrastructure powering these multiple use cases. And I do believe that there is a requirement for tech stack which are optimized for these various lending models, right? Whether it's a credit line, BNPL, right? We're seeing that already with B2C BNPL, and I think B2B is also sort of on the rise. So that's definitely our view as well as an API banking company that a lot of the things that you talked about, actually using multiple different providers to build together a stack. Maybe there's also a lot of scope to have a unified stack, right? That's a plug-and-play stack, catering to every company's requirement, right? And the fact that every company is a fintech company, and also the fact that lending, I think even Kunal Shah had mentioned that in one of his Twitter quotes, that lending is a feature, right? Across the board, across businesses, you can enable credit, right? Access to credit for your customers, for your customer base, and that's the approach that we also think is important for us to look at the next level of or the next stage of lending, basically, right? Coming to another really cool or really hot topic, whichever you want to look at it, is co-lending, right? Especially after the digital lending guidelines came out, we've actually seen a lot of interest from existing NBFC partners who are using us for various services on how do they kickstart their co-lending journey. Of course, there are two aspects of it. One is the partnership with the bank or the NBFC. So the other piece is also the operational piece of it, right? How to get started. So Niraj, would love to get your view as a regulated entity in this space, and somebody who has been in the space of co-lending. How should a lender get started from an operational standpoint? What kind of challenges of recon, of repayment, of sort of setting up the operations? Do help us understand a little bit more on that.
So, and we have ourselves set up co-lending in the last 2-3 months itself, post DLG guidelines. And as we were setting up, we realized that it is not very different from what we have been anyways doing with the fintech partners as a lending service provider, right? Most of the stacks, most of the things which NBFCs or REs are using with LSPs remain similar. It's just that on the other end now, instead of being an LSP, there is another regulated entity. Instead of maybe some sort of a FLDG construct, it's a co-lending capital construct, right? X of that, most of the things are similar. Setting up an escrow account where the two entities can pool funds so that the customer is unimpacted in the form of disbursal. He doesn't care about, hey, do I have one entity lending to me or 4 entities lending to me? I need to get funds in one shot. So purely from that perspective, and also from a mixing of funds perspective, an escrow account is mandated both for disbursal as well as repayment collection. Typically, again, most LSPs had their own LMS anyways. Similarly, most NBFCs again have their LMSs anyways. So it's just a matter of doing the right set of mapping upfront, is whose loan is what portion, such that both the entities are appropriately dividing the loan and tracking it, right? So when we work with other new age NBFCs, we have realized that these things are already solved for. Currently, we're not working with any large banks or any very old seasoned NBFCs. So we're not sure what kind of challenges could come up if we work with those in terms of the operational flexibility and operational setup. And just to reiterate, in other words, co-lending is nothing but it's a LSP fintech arrangement only. But if an LSP has an NBFC license, they are preferring to do co-lending because then the lending is happening under a regulated ambit. Both the entities are regulated. There's no requirement of FLDG because both the entities are putting their funds. And of course, the operating NBFC here, which is the risk-taking NBFC, can always take risk to the extent of their co-lending amount without explicitly having to take FLDG, which is, let's say, a frowned-upon practice.
Got it. And just a follow-up question on the fact that, let's say in case of two NBFCs, in this case you've mostly worked with very tech-first NBFCs. But the moment the laggards, if I may put it that way, in terms of tech come in, what kind of challenges do you see in terms of, let's say, two LMSs interacting, recon, right? Because that's one thing that we've also heard a lot. We, of course, from a payment perspective, recon is a very important part of what we do, right? And we've heard this from a lot of NBFCs, and we're also building for it on how do we solve the recon problem, especially in co-lending for small ticket size, high volume loans. So do you see that as a challenge? Do you think that there is a need for a solution, or do you think it's just about a common protocol of sorts that's needed? Just like in payments we have sort of common platforms. Do you think that even in lending there is a requirement for certain common protocols to be followed to ensure that there's better access to co-lending capital across the board?
So two things here. One is there are platforms which have come into the market which facilitate co-lending with some of these banks and all large NBFCs which may not be tech first, right? And introducing them or connecting them to new age fintech partners. Their new age fintech partners have lot of infrastructure in terms of the flexibility I meant. And then using that intermediary platform like Credflow, for example, they are able to then combine the two entities and help solve for some of these things. So that's one. Two is just the information flow, right? Co-lending, it is very simple. If the accounts both for disbursals and repayments are set in a standing instruction way, let's say as soon as the repayment comes, they have to be split in certain percentage, life becomes very simple. I think where recon takes a hit is because the complex arrangement between the two entities are very complex. It's not if I have lent into 80-10-20, my revenue will also be 80-20. Because now the customer facing rate is X and the hurdle rates between the two co-lending entities is Y. How is that being divided? How is PF being divided? Unfortunately, even fintechs, most of the fintechs don't have that infrastructure because every arrangement is a different arrangement. GST implication, all of those things, and therefore even we are today forced to follow a manual recon process. Even though customer facing journey is completely automated, completely digital, one would think that wow, everything is digital, but at the back end a lot of recon process is still manual.
Sorry, I was on mute. Got it, absolutely, Niraj. And adding to that point, Kunal, so would like to get your view looking forward, right? So what is, according to you, the lending infra stack 2.0, right? What is the lending stack 2.0 that you envision, which will solve for a lot of these problems, not just for the NBFCs but for fintechs like yours that are truly trying to sort of enable credit in the customer journey, right? So would love to get your views on that.
So I think one pointer you definitely mentioned is that there is a requirement for a common protocol, common infra, right? Which is say one or two companies powering the entire infra and enabling it easy, right? So for example, today for us to enable lending on our platform, we need to communicate with 10 different platforms and build that infra out, right? I think that is one big opportunity in my mind that exists. Similarly, for example, Niraj talked about the fact that there are a lot of companies coming in, right, which are enabling that co-lending stack, right, which are basically acting as a middleware between the traditional NBFCs and traditional banks and the fintechs which want to power this. And obviously these fintechs don't have the capability to interface with each of these players, and then there's a middleware which is coming in, right, someone like a Credflow, or say I think even within that there is a lot of opportunity for powering that infra in different forms, right? So for example, every different FI has a different LMS or LOS, right? Building a unified protocol to basically power so that you don't need to interact with each and every LMS individually, right? Similarly, for example, with respect to how the money flows work, right? That itself is, I think there is no common understanding between all the FIs. There are everyone has a different view between how the DLG guidelines will work and what is basically within the law and what is outside, right? So I think to power all of this, there is a definite requirement for certain infra companies to build this entire stack out, right, end to end, right? Not just powering payments, right, not just powering collections, but also basically bringing all of these players together on one stack. Even the for example, the LMS and LOS, etc. Right? So I think that is one big challenge that I see. Eventually, for example, one thing I see is that eventually every fintech will have to become an RE, right? I think that is the direction that RBI has very clearly hinted towards. And then what that essentially means that the entire lending stack will move away from an FLDG model towards a co-lending model. Right now, to power that, I think we are still slightly far away from being able to achieve that vision completely. Right. So, for example, today the kind of flexibility that fintechs have working with a lot of these NBFCs, that is something that needs to again change and again to go back to the kind of flexibility that fintechs used to have. For that to again come back, that infra needs to be built out, right? So that two NBFCs can and to an NBFC and a bank or a fintech, which is an NBFC and a bank, can interact very cohesively, and the entire stack around reconciliation, etc., can work seamlessly. I think that is something that still needs to be built for.
Absolutely. Completely agree with you, Kunal. In fact, from a payment perspective, also, the whole payment infrastructure was built keeping e-commerce in mind. But I think now is the time when it has to be built keeping lending in mind as well, and that's what we are also working towards quite passionately. We also have the audience Q&A. We have one question that's come up. We'll ask that to Niraj. But if anybody has any other questions, do put in on the chat. We have another 5 minutes to go. We also have a poll which will pop up on your screen for the attendees, and you have 30 seconds to answer. So look forward to getting your response on the poll as well. Coming to the Q&A, there is one question, and I think Niraj and Kunal, you can see the Q&A on your dashboard as well. So this is regarding co-lending, actually, a question on co-lending. So I'll request Niraj to answer this. What complexities do we foresee in the co-lending model, and can one entity in the co-lending model bear the entire risk, or will the risk have to be shared based on co-lending shares, or is it negotiable?
So complexities we see in the co-lending is, as I was speaking and as Kunal also suggested, RBI sooner than later wants every LSP to be regulated in some form or the other. Could be they become an NBFC, could be they become a digital NBFC, could be they become some other sort of lighter regulation. But what RBI wants is, if there is a large entity which can potentially become a systemic risk, not today but 3 years, 5 years down the line, they want to have some supervision on those entities. To that extent, co-lending is a solution to that, where it's saying now an NBFC doesn't have to work with a LSP, but two NBFCs are working together, where both of them are deemed fit and fine by the regulators. So then they can enter into a co-lending arrangement and do lending, where RBI can go and ask both of them whatever questions they have. So to that extent, we don't see any complexities in the model itself. The complexities will always be in terms of risk sharing, revenue sharing, recon mechanism. All of those complexities we discussed will remain, which leads to the second question is, can risk be shared by one entity? Our understanding and interpretation is that co-lending entities can take risk up to the capital they are providing, right? So, and it can be in the form of a first loss. So if let's say there is a co-lending in the ratio of 80:20, and let's say the entity or the NBFC putting in 20% is the operating NBFC, they can take the first loss default guarantee up to 20%. Now in less than 20% is a completely amicable arrangement between the two parties. They can say, we want to share the risk equally because revenue is being shared equally. That's completely fine. So I'm defining the maximum cap, but at max they can say that, hey, I'm getting disproportionate share of the revenue, so I am willing to take risk all the way up to my co-lending share, which is 20%, which effectively can potentially wipe off my entire capital which I am putting in. Anything above 20 is a gray area, is not answered, because even RBI has not answered if FLDG is allowed or not. If FLDG is allowed, then the operating NBFC can go from 20 to 100 also. If it is not allowed, then it will be restricted to the percentage which they are co-lending.
Great, thanks for clarifying that for the audience, Niraj. And it definitely is very clear now that lending is going to be sort of driven through partnerships, right? Whether it is a 100-0 model of enabling credit for your customer base, or an 80-20, 90-10 kind of a model. Kunal, when you mentioned that you basically have partnered with three NBFCs, right? Of course, in this case, you are not a regulated entity, so they are the ones who are actually sort of disbursing the capital, but you are giving access to the customer base, basically, right? So, how do you go about choosing? Because we get this question from a lot of fintechs. How do you identify which NBFCs to partner with? So, wanted to get your point of view on that.
I won't say we've perfected that, but my sense, and I think this is coming more from borrowed advice that I've got from a lot of people, is the fact that it depends the stage which you are at, right? So, for example, at an early stage, when you're yet to achieve product market fit, you need a partner who's there to work with you in a very flexible manner, right? At that sort of a stage, maybe a much smaller NBFC, right? Probably, so even if the cost of capital is say delta higher, right? You might want to work with them because you believe that those would be the right partners, at least to power the initial models and to be able to experiment and get to the right PMF. Then, for example, once you achieve PMF, then you scale up, right? And at that point in time, then you need more of people who have the ability or the capacity to give you capital, right? That at that point in time, for example, see some of the larger NBFCs, and for example, specifically, right, I've heard that NBFCs like ABFL, NBFCs like IIFL, right, they are fairly aggressive in the market and they're looking to expand their books very aggressively and looking to partner with fintechs as well very actively, right? So I think these are the kind of NBFCs then you would want to go with, partner with. I think one thing to be very cognizant of is not to allow concentration risk, right? Not to be very, very dependent on one NBFC at any given point in time, right? Because everyone has their own interest to protect, right? And it is very critical that you're not only reliant on one player for your entire book, right? You're partnering with at least 3 or 4 lenders who are able to chip in, right, whenever you need that additional capital, right? So I think that is the sort of approach to follow that at least I have learned from the industry.
Got it, understood. And I think we have another poll that you'll be seeing on the screen for 30 seconds. Do help us with that. I'll just pause for the poll to come in. Yeah. Great, thanks, Kunal, and very insightful. And I will really take home the point that I think, first of all, every company can be a fintech company, and lending being a primary aspect there. And the second very important point being that the entire industry has to move towards even fintechs looking for gaining regulatory sort of compliance, whether through licenses as an NBFC or like Niraj mentioned, a digital NBFC. It's going to move in that direction, and it's becoming very apparent even from the new direction from RBI, right? So it's a matter of time what the direction has to be. But I think the direction broadly is that regulations are catching up, and it's for the good, right? It's for the good because, like I said in the beginning, it helps separate the wheat from the chaff. We are almost towards the end, so before that, I just want to ask both of you one question. I'll start with Kunal. 3 interesting trends in digital lending that you're super excited about. Would love to hear from you on that.
3 interesting trends you mentioned.
Correct. Yeah.
So one, I think, a very important trend is the fact that more and more people are getting accustomed to digital lending. More and more people are adopting digital payments, and that is also powering digital lending. Second, I think probably I think the entire ecosystem coming together and uplifting this entire stack, right? Infra players, FIs, as well as the fintechs. And third, probably maybe I think the kind of innovation that is happening, right? A lot of new products coming in, right? And at the pace which fintech is progressing, I think it's leaving the entire world behind. And I think in that sense, India is actually leading the way. So I think these are 3 very, very interesting trends I at least take away from the recent few years.
Awesome. And then there's also one question that has come up from the audience, which I think is a follow-up to what you were saying in your last answer. Is that, do you foresee a deadline by which FLDG agreements will no longer be allowed? And this could be something that we can hear both from Kunal and Niraj, your view on that.
I think, I mean, if someone could predict RBI, then so it's very, very hard to predict. I don't know, I mean, when that will go. But I think at this point in time, what is very critical for any fintech is to move very quickly and at least get their things clean and I mean, at least be proactive rather than reactive once that happens. So, I mean, the timeline is short, is what everyone knows. Now, how do you get to that arrangement very quickly is the question.
Absolutely. Yeah. I mean, I think the point is the proactiveness is key, is super important because it will catch up. I think that's the whole point, right? And whether it is in payments, it's in lending, I think it's very apparent now that you have to build for the long term. You have to think compliant and build for the long term. That's super, super critical. Niraj, your answer to 3 trends that excite you. Would love to hear your views.
So one of the key trends which we have been seeing is every company wants to become a fintech, and every fintech wants to do lending. Because seems like in fintech, lending is where most of the money is, right? So that we have seen like over the, and we work with like 30-40 partners, and we have seen this common trend like, hey, we didn't start as a lending company, but now we want to introduce lending, either as an LSP or as a BC or as a co-lending, whatever be those arrangement, but everybody wants to test out and do certain things in the lending. And we have seen players which did not start as a lending, but today lending is the key mode of their success, or 80%, 90% of their revenue is coming only from lending, right? And the second thing is also actually a derivative of that, is how are these people able to do lending? Because they didn't start as a lending company, so they've got access to a lot of non-traditional data, right? Which if somebody applies to a bank or an NBFC, I am limited to a bank statement and or a bureau statement. While some of these fintech platforms or e-commerce platforms or any other platform, the quantum of data they have in terms of transactions and whom do you work with, whom do you not work with, debits, credits, SMSs, although some of those are or may not be allowed in the near future. But that enables lending, that enables these fintech / e-commerce players to be able to figure out who wants what, how much, what interest rate will they take and will they not take. All of this has evolved a lot in the last couple of years. And third will be all on the infrastructure side, right? Because if the market share of these fintechs / new age NBFCs has to grow, the infrastructure has to evolve. The regulation also to some extent has to evolve, like clarity on FLDG, no clarity, because no one wants a scenario or an instance where things are going well and then one day RBI comes up with new regulation which says, sorry, you can't do this, right? So that clarity is required, and I do see that RBI is coming up with those clarities sooner than later. But again, to answer like FLDG question, when will the clarity come? No one knows, but everybody's expecting that since DLG 1.0 was released 4-5 months ago, DLG 2.0 is probably warranted sometime in 2023.
Got it, absolutely. And one very interesting point you made is that the access to non-traditional data, right, and the quantum of it actually makes it very exciting, because many of these companies have not started their journey as lending companies, and hence the customers are coming and using certain key products in their platforms, and that really gives access to a lot of interesting and useful data, right? Thanks so much, Niraj, and thank you so much, Kunal. I think this was a very insightful conversation for me. I know there are a few more questions that have come up, but unfortunately we have run short on time. Maybe next time we'll try to keep the webinar a little bit longer, so we can also answer the questions live. But I'll request the audience for any pending question that you have in your mind. Do reach out to us. So we'll be sending you a follow-up email. Do respond to that with the question. We'll try to get the responses from the speakers and get back to you, definitely.